Is the tech sector about to face a disaster? Wall Street's latest moves in the options market suggest a storm could be brewing, and traders are gearing up for a potential meltdown. Find out why deep out-of-the-money puts are in high demand and what this could mean for your investments. Welcome back to our channel, where we delve into the intricacies of the financial markets. Today, we're focusing on a pressing development that has everyone on Wall Street talking: the dramatic rise in bearish options activity on the Invesco QQQ trust. With the Nasdaq 100 index having soared 43% from its April lows, traders are now betting on a sharp downturn. But what does this mean for investors, and should you be concerned? Let's explore the key factors driving this market sentiment, including the critical role of put skew and the significance of the QQQ's 200-day moving average. Wall Street is sounding the alarm over an impending tech market shakeup, with traders on a frenzy for deep out-of-the-money puts. These bearish options are tailored to profit only if there's a significant downturn in tech stocks, indicating strong fears of a looming plunge. This surge comes after an impressive 43% rise in the Invesco QQQ trust, a fund tracking the Nasdaq 100. But now alarm bells are ringing in the options market that this rally might not last. Traders aren't just preparing for a minor dip, they're hedging against a massive fall, showcasing rising anxiety in the sector. Central to this market sentiment is the metric known as put skew, which measures the cost of deep out-of-the-money puts compared to milder options. A high put skew indicates that traders are bracing for severe drops, pricing in tail risks, rare but extreme declines. At 22Vi Research, analyst Jeff Jacobson notes that the 2-month put skew for QQQ nears its 3-year peak, attracting institutions aiming to protect hefty summer gains. The market's rapid ascent and focus on major players like the Magnificent Seven have spurred many to reevaluate protection strategies, making the put skew a critical consideration in today's investing landscape. Focus also intensifies on the QQQ's 200-day moving average, a key long-term support threshold. Currently, significant attention is drawn to the October 2025 put option, with a $515 strike, sitting right at that 200-day level. Past declines in QQQ have averaged around 12.5%, aligning closely with this threshold. Jacobson hints that should a more substantial tech pullback unfold, this could serve as a natural stopping point. Rather than an anomaly, it would mirror previous patterns, which is why options traders are deeply interested in these levels, preparing for, but not fully expecting, a potential descent to that mark. In this environment, disaster deep puts are becoming more appealing due to the reduced cost of volatility insurance. The VIX, a common measure of market volatility, sits near its 2025 lows, making long-dated puts an affordable protective mechanism. This cost-effectiveness drives demand among traders seeking to bolster their defenses affordably. Meanwhile, the index's reliance on a few mega-cap tech stocks raises fluctuations risk if sentiment shifts abruptly. However, despite these signals of caution, Jacobson sees an opportunity to capitalize rather than a reason to panic, suggesting the market may be overreacting to the perceived threats. Jacobson, while recognizing the prevailing concern, doesn't foresee a tech market catastrophe. He anticipates, if anything, a more typical market correction in the 5% to 15% range, which would align with historical patterns rather than a full-fledged collapse. The current elevated put skew, the premium paid for deep downside protection, in his view, creates an imbalance ripe for exploitation. His preferred strategy? Selling high-priced tail risk puts to fund moderate hedges, optimizing returns by leveraging fear to implement a calculated approach. By employing ratio put spreads, he aims to benefit from declines landing near key technical supports without alarmingly breaching them. To summarize, Wall Street traders are increasingly hedging against a potential tech sector downturn by purchasing deep out-of-the-money puts on the Nasdaq 100 index. The high put skew indicates a growing appetite for crash insurance, although some analysts argue the market could be overreacting. Despite the heightened anxiety, opportunities exist to benefit from this imbalance in pricing, particularly through strategic options trading such as ratio put spreads. As the tech rally appears to be on borrowed time, understanding these dynamics can be crucial for investors looking to safeguard their portfolios. What do you think about the current tech market situation? Are you preparing for a potential downturn, or do you believe the fears are overblown? Let us know in the comments below. Don't forget to like, subscribe, and hit the notification bell for more insights into the financial markets and strategies to protect your investments.